Good morning, my name is Alfonso Galante and I am the Head of Strategic Planning, M&A and Investor Relations here at Unipol and UnipolSai. I'm going to take you through our first half results today. On June 30, we announced restructuring plans which have clearly impact on our results, which means this isn't a shoot the lights out first half. The underlying results of the business are strong, very much in line with Q1, and are continuing evidence of our progress as part of our strategic plan. The streamlining of the insurance business and the setting up of the NewCo will allow us to operate as an integrated business model and extract maximum value from our asset moving forward. So let's start with the consolidated results. In order to give a clearer picture of the underlying performance of the business, we have provided a normalized set of results which exclude the impact of the transaction. On this basis, this is where we are. At Unipol, both life and non-life show an improved performance when compared with this time last year. Our net consolidated result stands at 390 million euro. Again, for clarity, this excludes the overall minus 780 million effect of the transaction. The normalized results at UnipolSai also show a positive trend in both life and non-life, but were affected by write-downs of the banking sector pertaining to UnipolSai for a total of 105 million. With that in mind, and including the effects of the transaction, the net consolidated results for the first half of the year is a loss of 390 million for Unipol and a profit of 282 million for UnipolSai. On the non-life side of the business, we see a similar trend as in Q1. Pressure on pricing in motor resulting in a declining margins. This is offset by a healthy performance in the motor business. Total premiums are 4,026 million at Unipol and 3,673 million at UnipolSai. The combined ratio after insurance for first half of the year stands at 97.1% for Unipol and 97.9% for UnipolSai. It's worth remembering that due to a seasonal effect, the combined ratio of Q2 and Q4 always tend to be higher than the other quarters. Let me add, we felt the impact of Nat Cat and significant claims, which is roughly 1% for both companies. Drilling down on the motor business, the same trends for Q1 continue into Q2. The decline in average premium alongside stable frequency has resulted in a slight increase in the combined ratio. Although the ratio is now above the 100% mark, this is in line with the performance across the market. The number of black box employed has also continued to increase, with 35% of our portfolio now using this technology. Right, turning to our other insurance companies, there is very little that needs to be said here. I'm highlighting, however, the continued strong performance of Unisalute, both in terms of growth and its excellent combined ratio. As a reminder, Unisalute and Linear will be sold to UnipolSai as a part of a reorganization process. We expect this to be finalized by year-end. On the life side, the decrease in premiums at both Unipol and UnipolSai once again follows the trend from Q1, given our clear strategy to limit the sale of traditional products. Total premiums are 2,300 million for Unipol and 1,931 million for UnipolSai. On the investment side, we have maintained the gap between the average yield and the average minimum guarantee, which is partly linked to our cautious approach to the sale of new products in the life business. The figures are 1.7% and 1.5% for Unipol and UnipolSai respectively. Okay, now we come to the restructuring of the banking business. The steps involved in the transaction are as follows. First off, we will increase the average coverage ratio of non-performing loans portfolio to 80% for bad loans or sofferenze, 40% for unlikely to pay, and 50% for past due. The net figure for write-downs at Unipol Banca is 0.9 billion euro. At group level, a further 105 million euro is directly accounted for by Unipol. In order to absorb these write-downs and to finance the NewCo, Unipol Banca will receive a capital contribution of around 900 million euro on a pro quota basis from both Unipol and UnipolSai. Following this, a portfolio of roughly 3 billion euro of gross bad loans, sofferenze, will be transferred to a new entity, the NewCo. The NewCo will be financed by 300 million euro of capital and 300 million euro of debt, once again on a pro quota basis. The impact of net consolidated results of Unipol at year-end is expected to be around minus 780 million euro. That said, that means that Unipol Banca can now focus on its core business, while the NewCo specializes in the management of non-performing exposures. Looking at the bank in more detail, as you can see the situation post-split. The level of net NPEs at Unipol Banca will be very low, around 500 million euro, with gross NPEs as a percentage of total loans standing at around 10%. The NewCo will manage around 600 million euro net NPE. The impact of the restructuring process can be clearly seen in this slide. Firstly, the net result for the period at the bank is minus 712 million post 920 million in write-downs, which have already been accounted for at the bank. A further 105 million accounted for by Unipol Gruppo as a part of the guarantee agreement brings the total write-downs at group level to 1,029 million euro. This leaves an overall coverage ratio of 70.4%. The breakdown is seen on the next slide. CET1 ratio at Unipol Group level is 26%. What is important to note here is the increase in the value of loans classified as sofferenze from around 2.6 billion euro to just under 3 billion euro, which is basically down to more stringent and more prudent reclassification criteria. This increase is made up of loans previously classified as unlikely to pay and past due. Following these provisions, the coverage ratio is now at the highest market standards. That's 80% for sofferenze and 70% for total NPE. No big changes in terms of asset allocation from Q1. The running yield, 3.5% at Unipol and 3.6% at UnipolSai, continues to stand at a very satisfactory level. This result is positively impacted by the change in asset allocation in previous quarters and by a higher level of unrealized gains. Very little to add on real estate. In terms of Solvency II, the economic capital ratio of Unipol is 1.53 times, while the ratio for the standard formula with USP is 1.33 times. For UnipolSai, the economic capital ratio at the consolidated level is 2.18 times. The ratio using partial internal model for UnipolSai solo is 2.56 times. This ratio remains strong. The strategic action that we announced on June 30th are instrumental in making Unipol Gruppo and UnipolSai better and more efficient institutions. Our business is in good shape. We remain focused on growing the business, improving our competitive position and rewarding our shareholders.